Everybody, and welcome to the first Urban Living webinar of the second part of the year. I hope you all had a good summer. We're back, we're full of beans, and we're ready to go for the next few months to bring you all the cutting edge topics across the living sector. And today we have a really great subject to get our teeth into. We'll be taking a deep dive into dynamic pricing in build to rent. My name's George Sell. I'm the editor of Urban Living News, and we are a B2B multimedia platform for the living and flex workspace sectors. Today's webinar is going to last an hour. We're going to have around 45 or 50 minutes of panel discussion with our terrific speakers. We'd like to make it nice and interactive, so if you have any questions, do submit them along the way using either the chat or the Q&A function in Zoom. A link to a recording of the session will be sent to everybody who has registered via email. And at the end of the session, when you log off, there will be a quick survey appearing in a pop-up, and we'd be really appreciative if you take the time to fill that out, just so we've got a better idea of the topics that you want us to discuss on this webinar series. So before we meet our panelists, I just wanted to show a few slides, context slides, just to give you an idea what we're going to be talking about today and to frame the discussion. Could we just go back to the previous slide, actually? You skipped on one there. Yeah, okay. So if we look at these from left to right, the first one is from an academic paper from the University of Texas, and the headline there is pretty self-evident. Dynamic pricing can optimize profits, but alienate customers. So there's the first thing we've got to take into account, is getting the balance right here. The middle one I put in just because it's an appalling pun from City AM about the Oasis ticket price thing, which is when dynamic pricing hit the headlines most recently over prices for their comeback tour. And then there's an FT article, again, a pretty sensationalist headline there. Why everyone hates dynamic pricing. Consumers are particularly indignant if they suspect algorithm is to blame for price hikes. So, you know, this is a sensitive topic and one which has to be given a lot of thought to get right. So if we go on to the next slide, the CMA, which is the competition authority here in the UK, has been looking at dynamic pricing in general, and I just think it's worth picking out one bit from the slide on the left here, which is that their conclusion was that they're not going to apply any kind of knee-jerk blanket reaction to the situation here. And the sentence that jumps out at me is that it says that may mean that sector-specific interventions may be the most proportionate and effective way to tackle problems that may arise from dynamic pricing, rather than changes to wider consumer law. So there's not going to be a one-size-fits-all approach here, but there is potentially going to be sector by sector action. And we've already seen that they've been looking at information sharing and price collusion amongst house builders in the UK. So it would be a surprise if they weren't looking at build to rent, more of which later. So let's meet our brains trust. I think we have probably got the some of the most in-depth knowledge of dynamic pricing in build to rent on the session today, I'm glad to say. I'm going to ask the guys to introduce themselves from left to right as we see them on the screen. And I'm going to start with you, Richard. Tell us a bit about what you do, and also maybe your previous role, which has relevance to this discussion.
Thank you, George. Yep. So my name is Richard. I'm the Managing Director of Moda Operations. So we're a BTR operator. We've currently got assets from Edinburgh down to Hove. We started in Manchester with Angel Gardens. We've grown the business in the last 5 years by about 610%. So a massive growth from our side into the BTR market. Still pretty new operators. We're entrepreneurial, we're nimble. Believe we've set a benchmark. We're premium level BTR, and our assets are actually the fantastic, beautiful properties around the UK. My previous role was within Marriott Hotels, where we used dynamic pricing a lot within the hotel industry. And that's where my in-depth knowledge has come. Within the BTR markets, still very basic level industry within the UK. It's how we tap into my previous experience at Moda and with Marriott Hotels into Moda to make it a little bit more sophisticated. And that's the journey we're on right now.
Great stuff. Thank you, Richard. And now we go down under and say hello to Greg. Welcome.
Thank you, George, and great to be here. As many of you may have picked from my accent, I'm based in Sydney in Australia, so it's in the evening here. I'm an actuary by background, and as my wife keeps reminding me, I'm extremely passionate about dynamic pricing, especially in the build to rent industry. I'm the founder and CEO of Price Wizard, and we help build to rent operators grow their rental income by optimizing rents. In other words, we help them apply dynamic pricing, and we're typically able to achieve uplifts of about 3 to 6% of rental income, and that's the equivalent in a 20 to 30 story building of just magically adding another story onto the building with zero capital outlay and no government approvals.
All right, that's a convincing argument for it. Thank you, Greg. And finally, David, when we were putting the panel together for this session, several people said you have to have David Woodward on there because he's got the most experience of dynamic pricing in this sector, both in the US and UK. So can you give us a quick intro and a kind of summary of your experience with dynamic pricing today?
Sure. Those were surely my PR people,
They
George.
weren't. No, they weren't.
So yeah, I'm David Woodward. I'm the CEO of Global Apartment Advisors, GAA, which is a living sector consultancy based in London, but doing work all around the world. Also, we have a sister company called Compass Rock, which owns and operates built-to-rent assets in the UK and Ireland. But my background is from the US. In US multifamily, as it's called there, revenue management really has been around now for 20 plus years, 25 plus years. But it just so happens that I was with the apartment REIT, Archstone, which was a real innovator in the space and really developed the first in-house revenue management software program, which they later commercialized and sold to the market and sold off the business eventually. And this was before YieldStar came along. So I've been involved in revenue management from the kind of the early 90s and very early days. So that's probably why you got that feedback.
And you said, David, on the before the call started that it was actually the late 80s when people started thinking about the
Yeah, well, I mean, I think the real reference point is American Airlines in the 70s started using dynamic pricing, which they called yield management back then. So you know, it's been more well established in airlines and then hotels long before it came to multifamily and BTR. But yeah, you're right. In the late 80s, I'm dating myself here, but we had an in-house program that we called PET, price every transaction, and it was very kind of on spreadsheets and just, you know, this unit, this time of year, this aspect, this floor level. It was just like how to get squeeze a little extra revenue out of out of pricing. Because prior to that, you know, one bedrooms were all the same price, two bedrooms were all the same price, you know. So that was the early days of this concept coming along. And I will tell you that when we developed the software, the first revenue management software, the market hated it. The brokers hated it, the operations people hated it, everyone kind of hated it because it just they were so used to this static pricing model, and it just added a level of complexity they weren't used to.
How long did it take to win people over, David?
Years,
Oh,
years.
interesting. Okay. Thanks, David. Okay, so picking up on that, Greg, let's come to you and maybe you can just give us a quick dynamic pricing in build to rent 101. What is dynamic pricing in the context of build to rent? How does it work?
Yeah, sure. So David gave us a bit of the history and the context outside the build to rent industry. Within build to rent, I actually prefer the term scientific pricing rather than dynamic pricing because I don't think build to rent operators should be updating prices every day like you might see in the airline industry or in the hotel industry. But I do believe that regular updating of pricing is important. And most importantly, the scientific approach. We all have lots of data here, and it's really about making the most of that data. And if you don't, then it's a missed opportunity. It's a bit of an own goal. And we want to be using scientific techniques to do that. So that's why I prefer the term scientific pricing, but I realize that the name dynamic pricing has stuck, and I fall into the trap of using it all the time because it's just familiar to everybody.
Yeah, well, we'll move on to the terminology in a bit, perhaps, because it is a double-edged sword. It hasn't got a particularly good rep in general at the moment, but we'll come to that in a bit. David, why is more sophisticated revenue management becoming increasingly important in build to rent, and how is it evolving in your experience?
Yeah, I think as Greg said, and you said, the study out of the States that shows that the revenue lift can be anywhere from 3 to 5%, and that's been borne out, over the last 25 years, number of studies that's real. So if you think about generating that amount of additional revenue, it's very high margin revenue. To Greg's point about adding another floor on your 20-story building. There is some cost because you got to perhaps buy software and maybe hire either a company or a person to help manage it, but it's very, very high margin. So in an investment environment, especially in the UK, where just getting deals to pencil out is so difficult. It can be that little edge that allows you to hopefully acquire an asset that you might not otherwise be able to.
And are kind of investors and funders of new buildings, do they expect this to be a given now? It needs to be part of your strategy right from a blank sheet of paper.
I don't, in the UK, no. I mean, it's still, as Richard said, it's still kind of early days in the UK. In the US, it's much more common and expected. I would say most bigger operators in the US are using some type of revenue management system or approach or philosophy. There's been a few legal issues lately, but I think that's all going to get worked through. The concept, I do know a bit about the legal issues that are going on in the US, and it's not because of the concept of dynamic pricing. It's because of how some of the data was managed. So the concept is not bad per se. It was just the approach that was taken in a few specific areas.
Yeah. I mean, we're used to dynamic pricing for kind of one-off purchases, leisure purchases, flights, hotel stays, and this kind of thing. But obviously, we're talking here about applying it to a person's primary residence. Where they lay their head down at night. One of the basic human needs. So, Greg, how can dynamic pricing be a tool for efficiency and growth while remaining fair and ethical in this sector? How do you strike that balance?
Sure. Well, we'll start with the efficiency and growth part, and I'll just reiterate what David said in terms of getting incredibly high returns on investment for focusing on dynamic pricing. And then turning to the ethical element, we find many of our clients come to us starting with an occupancy rate, let's say somewhere in the 80% range, in the 80 to 90% range. And then the plan is, and we've been able to achieve this, to get them up well into the 90s, into the mid to high 90s. And that might be an extra 50 residents per building. And so if you consider that dynamic pricing can mean higher occupancy rates, it means more people have a roof over their head. It means less people sleeping on the streets. I actually see dynamic pricing by providing higher consistent occupancy. It takes a step towards improving the housing crisis. I mean, it's not going to solve the housing crisis on its own, but it's an important part of a much bigger picture. So from an ethical perspective, I actually think dynamic pricing is a real positive. And I no doubt we'll come back to the data sharing aspect as well. And I'll echo the comments that David just made, that you can certainly do dynamic pricing without data sharing.
Greg, just for a bit of context, your client base is mainly in Australia, mainly in the UK. Where are you working predominantly?
a combination of the two.
And how do the two countries compare in terms of their progress with dynamic pricing and attitudes towards it?
So the US market is many years ahead of the UK market in terms of build to rent, and that flows on to dynamic pricing. The UK build to rent market is more established than the Australian market is. In terms of dynamic pricing, I would say both are at a fairly early stage of evolution. The majority of operators at this point in time are not using professional dynamic pricing. That's starting to shift, but that's where the majority of the market are. And I think there's a lot of upside there for everybody in the industry to start investigating how they could go about pricing more scientifically.
My sense, George, if I could just jump in,
Sure,
is that many of the fund managers, all of the fund managers, will be aware of dynamic pricing and probably aware that it's something that will come, needs to come in time. Conversations that we've had with some of them, and big name funds. There's a little bit of like, do I really need to engage in this? I've got so many other things going on right now. So there's a little bit of kicking the can going on, I think.
yeah.
One fund manager told me that they'll turn their attention to revenue management when they hit 10,000 units, just because, which I think is very flawed thinking, frankly. If you want that extra 3, 4, 5% of revenue, you could have that today. You don't need to wait till you get to 10,000 units.
Yeah, interesting. Richard, you mentioned your background in the hotel sector, which is obviously much more experienced in dynamic pricing and much more sophisticated. What types of data do you think are needed for effective dynamic pricing in build to rent? What are the parameters? What do you need as the raw material to make a dynamic pricing strategy work?
Sure. It's very similar actually to hotels. It's based on demand and the product you've got available, the seasonality as well, and the competitor pricing. So the basic factors, in my opinion, are the same. But it's how, I think Greg mentioned this, hotels, airlines, is very transactional, it's very instantaneous. With BTI, you're talking about people's homes. So I think given the certainty and the terminology of dynamic pricing does have a negative connotation, but given certainty to the pricing that you're going to be charging, and when you have a brand to support that as well, it brings an air of confidence that I'm paying for my home the right price when I want to rent that home. But things change. I mean, I could be living in an apartment next door to someone else, the same apartment, same view, but I rented it 6 months later and I want a shorter terminology of the tenancy agreement. I only want 6 months, not 12 months. So there are so many layering of factors that come into play. But I think the confidence of certain elements of, I guess, maturity within the BTR market, because you're dealing with a product that is very personal. The home is critical, as you mentioned earlier. It's not transactional like an airline or a hotel. So I think once you do the scientific, go back to what Greg was saying, analysis of what you want to charge. At Moda, we spend an awful lot of time, even before we've opened a site, in analysing every element of the units we have available, where they're located, what the size of the area is, what's within the actual apartment, all of those factors when they're becoming to market, how we want to leverage. We all know that studio apartments probably go first in most mixed developments of BTR. How do you hold back that pricing? How do you maneuver some of those units to be coming onto the market later so you can push the 1 beds, the 2 beds, the 3 beds? I think also that collusion factor, that's where it goes wrong. If you're in collusion with others who sell the same product, that's negativity. We never, ever would ever do that. And I think that is the bit where the negative press would come into play. If we were to be aligned with Greystar, Granger, Get Living, and start to price the actual market we're trading in, that's negative. And that's something that we definitely would never be supportive of. And I don't think anyone within the BTR industry would want to do that anyway. But that's where the negativity comes from, because you are dealing with a price point which is very, very personal to people. So I think if we can overcome that negative press, give certainty of pricing, the certainty of why we've come to those, so be very upfront, we have priced this unit based on the following factors. I think that's very, very powerful.
Yeah, Richard, if I'm thinking back to when we first rolled out revenue management in the States many years ago, and the traditional approach for leasing was anywhere from a 6 to 12-month lease, and more typical just to have a 12-month lease. And so one of the things that came into play with revenue management was the ability to do shorter term leases, because the conventional thinking was so ingrained. I remember talking to property managers back then and saying, would you offer a 3-month lease? And they said, well, no, not really. That's a lot of extra work and don't want to do that. And I'd say, would you offer a 3-month lease if you got, 20% more rent or 30% more? And they said, oh, yeah, we would do that. So the point was, you will under the right terms. So it kind of opened people's thinking up to shorter term lets, leases that might expire in the winter months, which is more difficult to backfill. You can back solve all these issues with price. It's the ultimate lever.
Yeah.
So the point is, it ended up offering more choice and more options to the customer.
Yeah, agreed.
David, we all expect and know that when we're booking a flight or a hotel, dynamic pricing is at play. I mean, we've probably all had the experience of looking at a flight one day, hesitating, going back to book it the next day, and it's already more expensive. I know it's happened to me on more than one occasion.
Yeah.
When dynamic pricing became a given in the sector in the States, how was it communicated to customers? And now are they fully aware, and do they know that these techniques are being used and that their neighbor might be paying a different price from them?
Yeah, it was really difficult, honestly. I mean, it took a lot of time and a lot of training. And again, I remember setting up these training programs for, at the time, it was, a property manager who was probably communicating, or a leasing manager that was communicating the pricing. And so we had to come up with kind of scripts as to how to explain, prices change all the time, kind of like the airlines, kind of like the hotels. We use that as a reference point. So it took time is the answer. And now in the US, any renter would know it's different. You come in a week later and it could be something different. I will say that it did create an opportunity to create a little bit of urgency. Prices do change. I really like you to have this apartment. If you can commit to it today, we can lock in this price. And so there was a kind of a hidden benefit in getting people to, because in the US, there's so much multifamily, you could drive, 5-10 minutes down the road and there'd be 10 different properties to choose from. So you really want to be able to not have that potential renter go shop around too much. You'd like to capture them right then and there. So that helped in a bit as well.
Yeah. And Richard, here in the UK, where the market isn't so mature, how do you think you will communicate that to your customers?
I think you've got to be upfront and say, look, the prices do change. The here and now price you see on the screen is the price we're going to charge. But of course, that could change depending on the factors that are in play. And I think because it's quite commonplace these days, even when you go on TV these days, you see Aldi's telling you that their basket of shopping is cheaper than Tesco. So you get to understand that the price point at a given time will always change and be fluctuation in the market. So I think just being upfront and honest is really, really important. If you try to hide and then just adjust, that's wrong. So from a Moda perspective, we always are very outwardly spoken about the price is the price. This is what you get for that price. These are the reasons for that price. And that's the price that you can be offered today. But that price could change, as it does, with seasonality, with length of tenancy, which obviously with the renters' rights will probably change next year.
Yeah.
But there are factors where if you're upfront and I say honest and transparent, then I think people get it. The people today are quite savvy. They understand it completely.
Yeah.
Richard, I'm really pleased to hear your perspective there, because we have a number of clients who don't want to be as transparent about using dynamic pricing, and they're concerned that if their tenants are to find out that that will cause negative publicity for them. So your opinion there is a breath of fresh air for me. Thank you.
And yeah, thank you, Greg. I mean, it's not easy, when you do have a cohort of residents who are paying so much, then another cohort paying another price, but you have to navigate that. And I think that transparency is really important. Having a mature approach is what's really important. From the site teams who deal with the residents to how you put it on Rightmove, that's really important. That transparency is critical.
Mm.
I think it's important to point out that pricing adjustments can be negative as well. I mean, can go down. So the unit that doesn't have the view, the unit that looks onto the back alleyway, or what have you, that needs to be adjusted downward. So that creates an opportunity for someone who's more price sensitive to be able to rent that apartment. In the old days, where pricing was all same, that was the unit that just never got rented. It just sat there empty for months and months and months. Now it will move at a certain price. And so that opens up an opportunity for someone.
Yeah. I think it's, in this day and age of residents having WhatsApp groups in a building and stuff, you have to be transparent, because these guys are going to talk to each other and they're going to find out, you can't stick your head in the sand.
Even before social media, they talk. They always talk. They talk in the hallways. They talk in the lounges. They end up asking, "How much did you pay for rent?" So you have to be ready. To Richard's point, you need to be transparent on the front end, but you need to be ready for those questions that come up downstream.
Yeah.
George, there's an underlying assumption in your question that dynamic pricing or algorithmic pricing or scientific pricing, whatever you like to call it, corresponds to different tenants paying different rents, whereas having a human doing the task of pricing corresponds to everybody paying identical rents. But of course, that's not the case. You can't have every tenant paying the same rent because their leases all expire at different times. And by definition, if they were all paying the same rent, you'd never be able to put the rent up for anybody. And in 50 years' time, they'd all still be paying the same rent as what they're paying today. It's a question of whether you adjust the rents in a small, incremental, logical manner, or whether you do it in a more haphazard manner. And I'd much prefer to be doing it in small, incremental approaches driven by a scientific approach.
Yeah. Good point, Greg.
Sorry, George, can I follow on with that from Greg as well? I think that's very good. And I'm aligned to that. I think one of the things that I'm trying to do within Moda is how do you layer in technology to take away some of those sort of emotive decisions? Enterprise intelligence is what this is about, which is a mix of AI and humans. How you mix the two together to come out with the right output at the end. So bringing technology into play is really important. It can look at millions of data points, whereas a human can only look at a few data points and be emotive about it. But if you combine the two through enterprise intelligence, then you have a win-win situation. So technology is really important, but also the human element is also as important.
Yeah, I was again thinking back to early days in the U.S. The other kind of hidden benefit of revenue management was that the pricing, which formerly had been mostly the purview of the on-site property manager, they had a lot of control over pricing within a budget, but they could kind of move rents up and down a little bit. That became kind of behind the curtain, like it would be in a hotel. And so as a result, that allowed the on-site team to focus on customer service. And so you're able to kind of separate, just in the same way hopefully when the clerk behind the desk at a hotel tells you the price you aren't happy with, you're not mad at the clerk. You might be mad at the system, but you're not mad at the clerk. So it allowed the on-site team to really focus on heightening the level of customer service. This is the rent that the system has told me. Here are a few options if you want a shorter lease, a longer lease, a lease that expires this month versus that month, all these options that became available that weren't available before. And then, what can I do to, get you the apartment you want and make sure you love it and all that stuff. So it changed the relationship between the on-site team and the customer.
Yeah. Thanks, David. Greg, did you want to come in on that?
Yeah, thank you. I just would like to pick up on Richard's comment. He was talking about combining the computer with the human. And a really good example of that for me is the generative AI tools such as ChatGPT that everybody would be familiar with, because I can assure you that ChatGPT can write far better than I can write, and it can review my work really well too. But the best outcome is when I set ChatGPT to work and then I make a few edits at the very end. I think that's how you get the most from the generative AI, or alternatively, when the AI reviews a human's work. But it's that collaboration between the technology and the human that gives you the best outcome. And I believe that applies equally with dynamic pricing as well.
Yeah.
So the human input, the revenue manager overseeing all of the technology is not going to go away anytime soon, then, you don't think, Greg?
I think if you look at a hotel or an airline context, you need the technology to operate really fast because of the timing of the sales cycle. Whereas in build to rent, you're not updating your prices every day and not even every week necessarily. So you've got a little bit more time for the human overlay. And occasionally the humans know what's going on the ground in a manner that the algorithm doesn't know, because the humans haven't told the algorithm about something that may be going on. And so, yes, I think that human overlay can be helpful.
Yeah, thanks, Greg. Richard, how can operators use dynamic pricing to find the sweet spot between maximizing revenue and high occupancy levels?
That's a really good question, and probably the question of all of this. The occupancy is critical, the optimum rent is critical, and how you get that balance between the two is still work in progress. I think that depends on where you are, the market conditions, all the things we've just been speaking about. But that is the sweet spot: maximum occupancy at the highest possible achievable rent, and that is really difficult to achieve currently. And I think because BTR is such a new industry, we're not there yet. We break into things, we fall into things. The world changes. I think that when there are aspects which are outside of your influence, it's very hard to get to that position. And that's where I think clever technology, clever people like Greg and David with their insight coming into play with the actual products is when we're going to be in a better position. We're not there yet. I think we're probably at least 1 year to 2 years away. AI is moving so quickly. It could be quicker, but in my little world, I'm thinking 1 to 2 years before we're in a position to be in that certainty of sweet spot.
Yeah, thanks, Richard. Greg, when large build to rent and multifamily buildings are in their lease up phase, we see a lot of hospitality type business, short stay stuff. I think can be as short as 1 or 2 nights. Is the technology available in one package to price the entire building from that hospitality end of stays all the way through to the 6 and 12 month primary residence stays, or does that have to be kind of run separately?
So that's a great question. I've never had that question before, George. So if you look at most of the organizations that provide dynamic pricing services, they either focus on build to rent or they focus on hotels.
Yeah.
And so that might lead you to think that they should be purchased separately. As for Price Wizard, we have worked with hotels and we do still work with a small number of hotels. We haven't combined the two products together. If there was enough demand there, it's certainly something that we could do, combining those two together and optimizing between them. Not something that we've done at this point in time, but certainly if there's anybody on the call that was interested in exploring that, we'd be very happy to chat to you.
Richard, David, I don't know if you've got any experience of that and whether those two kind of types of business have to be treated separately in revenue management terms.
I don't know that as Greg is saying, I don't know that the software solutions that are out there from the US address both or not. I think they are more kind of, they're either for built to rent multifamily or they're for hotels, and I haven't seen one that crosses over into both. However, I will say that in the world of BTR operations, and Richard will probably back me up on this, it just feels like the direction of travel is towards more and more flexibility and different length of leases and some short lets mixed in with longer stays and maybe some Airbnb units sprinkled in there as well. And so it's really, I think the evolution of housing is more towards more flexibility. So certainly pricing needs to address that.
Yeah, the revenue management picture is definitely becoming more complex, Richard.
Yeah, I think David's right. I mean, we've got a site in Edinburgh, and obviously, every year they have these major events in Edinburgh, and we have a few guest apartments. Our pricing is based on that local hotel market knowledge and how we price those units. It's that simple. So that human element looks at the hotel pricing through the event program through August, and then we just price our guest apartments based on that. For any resident who wants to bring a friend to come and stay, it's hotel pricing. And that's pretty crude, and we're not where we should be with that, but that's how we do it at the moment.
Yeah, thanks, Richard. Had a great question in from Chris Conway, who asks how you deal with renewals. For example, someone moves in September 24 and is paying £1,500 a month. A renewal is due now, and the system is suggesting a much higher rent. How do you approach this? David, do you want to kick off with that one?
Sure. Yeah, a lot of firsthand experience with this subject. So the answer is it depends. What your company strategy is, what your, who your investors or owners are, and if they're concerned about headline risk or not. So there's two schools of thought. You either just bring them up to market rent and say this is the market, or the approach that I personally prefer is it may not be meeting in the middle, but some amount off of the new market rent. And we actually our sister company Compass Rock, we had a property in Southampton here in the UK, and we had that very issue. And instead of giving tenants several £100 increases, we kind of took a little off. But importantly, back to Richard's point about being transparent and communicating, in the renewal letters, we explained, here's the market, here are the other properties that you're aware of, and here are the rents they're charging, and here are the rents, within a range. Here are the rents that we've been charging for your same type of apartment. We're not asking you to pay that number. We've knocked something off the top. So I personally think that's kind of a good approach, and you really want those residents to renew anyway, because obviously you minimize the void, you minimize the cost of turning that unit, and hopefully you engender a little bit of goodwill by not bringing them all the way up to market.
Yeah. David, while we're on the subject of rent increases, how do you think the Renters' Rights Bill is going to affect this whole process of dynamic pricing? Presumably it's going to introduce a whole new set of parameters to your algorithm, I guess.
Yeah, was that for me?
Yes, please.
Yeah, sorry. Yeah, no, it's going to be very different. So the question is, well, how joined up will the tenants be in understanding how it all works? I mean, you could still offer leases of different lengths, even though it's kind of irrelevant if you can give 60 days notice at any point in time. Certainly, you could still price, if you offer different lease lengths, you could still have some pricing and seasonality. But I think it's going to mute some of what revenue management does from what we have today. The units that have different, aspects or heights or locations within the building, all of that will still, apply. Really comes around the lease length bit. And I know operators are all, including ourselves, are all kind of, trying to figure out how we're going to manage through it. And is there an opportunity to still, to apply revenue management or less so? So yeah, TBC. I don't know, Richard, any thoughts on that?
Yeah, absolutely. We've got two properties in Scotland where you could argue renters' rights has been in place for some time. There's no real fixed tenancy term, but we actually don't have an issue in Scotland. People still seem to stay as long as they do within England. They're not, using their rights to exit after a few days. We use the same sort of dynamic pricing, revenue management data sets in Scotland as we do within England. So I don't think, as long as the fundamentals, going back to what David was saying, are still in play, it makes no difference. The renters' rights, I think, is great, and we need it, and it should be coming forward as soon as we can. but it makes no difference. We have not discovered any difference in Scotland layering in that same predicament down into England. So I don't see it being an issue whatsoever.
Interesting. Thanks, Richard. So you're not really seeing much of a variance in tenant behaviour in
No,
Scotland? No.
the
Okay.
tenancy length terms the same. There's no difference in Scotland and England from our portfolio.
That's interesting. Okay, thanks for that. Another good question has come in from Matthew Bates. And he asks, how frequently should pricing be reviewed and updated, and what resource systems and processes should be utilized to drive these pricing updates to an applicant on a live basis? Who wants to pick up on that one first?
I'm happy to pick that one up. I think that's a great question as well. I think you should do it as much as you want to do it, which isn't really the answer perhaps people are expecting. If you've got such high demand for your development, then you should be doing the pricing analysis virtually every day, every week. Yeah, that's unusual to be in that predicament, I would say, on a long-term consistent pattern within BTR because of the seasonality that we're all in, the student in and out basis. We do it probably twice a year, Moda, but it depends on the demand. If the demand is through the roof, then you should be looking at your pricing constantly. And if demand is low, again, you should be looking at your pricing. How do I bring the occupancy up? So there's not a single, I wouldn't say, regime that you should follow. You follow what your development and what you need in your development. Do you need higher occupancy, higher rents? Do you need both? And then you take the analysis of the market where you are, and then make your pricing as, I guess, as fluid as it can be at that point in time, as long as you're transparent about it.
Yeah. Greg, what would you advise your clients on that point?
In terms of frequency, I mentioned earlier the sales cycle is longer with build to rent than it is for flights or for hotels. And a lot of tenants that are looking to move into a new building for them, they wouldn't be expecting to see the rents suddenly changing every few days or even every week. So I feel somewhere between fortnightly and monthly is probably about right on average, and there may be exceptions to that. But there's no hard and fast rule, as Richard said, and there'll be different circumstances where a slightly longer or a slightly shorter time frame applies. I think what's more important than getting exactly the right time frame is having the discipline of reviewing your rents on a regular basis and using a scientific approach in order to do so. If you don't mind, I would like to come back to a question that you asked David a moment ago about renewals and the trade-off between prices for renewing tenants versus new tenants. This
Sure.
is an area that we spend an enormous amount of time on, and I actually believe it's one of the most important aspects of pricing in build to rent, because you have this trade-off between having the same price for everybody, whether they're renewing or whether they're a new tenant, versus on the flip side, especially in a strong market where rents have gone up, between holding the rents at constant or at a very low increase for renewing tenants, which means you'll have to fill less vacancies, which means you can get away with charging more for your new tenants. And there's a real spectrum in there of how you go about that. And we focus a lot on trying to get that relationship right and understanding what the demand curve looks like for new tenants and what the demand curve looks like for renewing tenants. And they look very, very different to each other. And we use those demand curves to build a forecast. And I think forecasting is the absolute key to getting pricing right and understanding what's coming up ahead of you and getting this right balance that you asked Richard about earlier, between pricing too high versus too low and getting occupancy too high versus too low. If you can't forecast accurately, to me, it's like driving a car looking in the rear view mirror. Forecasting is absolutely critical.
What are the data sets that you'd use for that forecasting, Greg? And is there anything that might be outside the obvious? Because it's in a mature market, it can be quite a nuanced thing, can't it? You know, 2 streets away can be a completely different dynamic, for example.
Yeah, that's right. Well, I'll tell you one data set we don't use, and you alluded to it earlier, and that is our other clients' data. So we keep each client's data completely separate, and I think that's appropriate. So what do we use? I'd say we rely 60 to 70% on the data from our clients and the attributes of each apartment in the building and the history in the building. Because what's happening is tenants are voting with their feet. They're saying to us with their actions, not surveys that they complete, but with their actions, they're saying, well, we don't want to stay in this apartment at £1,050, but we're happy to stay there at 1,000. Or we can see that because we know which apartments have leased out quickly and which ones haven't leased out quickly. And that gives us a really good understanding of what demand looks like in every single apartment, and both for new tenants and renewing tenants. So for me, that's the most important source of data. And we're all sitting on so much of this data. It's a question of using it properly. We overlay that with market movements, broader market movements from publicly available information. And we need to do that because events that took place a year ago are a little bit out of date because the market price has moved. So we try and adjust what happened a year ago for what was the movement in the market. Now, we'll all have a slightly different view on what the market is. Uh, and there's no perfect answer to that. But most importantly, we like to get critical mass. So I'd rather have a larger number of data points in our defined market so that we're not too reliant on a very small sample. But that's a topic that we discuss and debate extensively with our clients.
Yeah, thank you, Greg. David, did you want to come in on that?
Yeah, sorry. Greg, I think it's a really important point. I just wanted to emphasize, again, some of the perspective, some of the clients GA clients that we work with, and we talk about revenue management. And one of the, I mentioned the fund manager who said, I'll wait till I have 10,000 units, which I think is not a good response. But the other response, and this is very common, oh, well, David, it all sounds great, but there's not enough data in the market. And so it's not really time for revenue management yet. And I completely agree with what Greg's saying. Your own property is its best comp. Your own property tells you what you've been able to rent the last, 5 2-bedroom apartments for over the last 30 days, and direction of travel. Are rents, are you able to push rents up, or are you having a hard time? So saying that there's not data available in the market is not an acceptable argument to me. And in fact, if you look in the UK, I wouldn't want to comp against the market because the market is so inefficiently priced. You've got mom and pop operators, you've got private landlords, you've got other built-to-rent operators who aren't doing revenue management. You don't want to benchmark against that data set. You want to benchmark against yourselves. So for anyone listening to this webinar, if those are two of the arguments you have against revenue management, I'd love to get into a debate with you.
Thanks.
Friendly
Thanks.
debate.
I think just to follow on to that, I mean, when Moda opened some of its first developments, we set the market. We created the market at that price point. And we took on board the quality of the service, the quality of the product, and the belief in our brand, and the belief in the delivery of a quality product. So quite often our rents are the highest in every market, because we believe that, in some of the markets we've worked in, that the market needs to be pushed forward. It's now very interesting in some of the markets we do operate, where we fluctuate our price, the comp set move their prices. That's really interesting to see that actually that maturity of people are starting to revenue manage, whether they believe it's called revenue management or something else, but people are starting to flex their prices.
Yeah, definitely a sign of market maturity. Thanks, Richard. David, just coming back to you, what do you think other countries can learn from the US experience, both in terms of best practice as a much more mature market, but also the kind of fallout from the antitrust and price fixing court cases that are going on at the moment? Maybe you can just give us a very quick.
Sure.
Sorry,
Yeah, I mean, I think first and foremost, revenue management works. It's been proven to work. It's worked in other industries. You're right, housing is a little more sensitive because it's where people live, it's their home. So it has to be handled more carefully. and explained more carefully, I think. But if anyone's wondering, does it really work or not? Is there really 3 to 5% out there of uplift? Absolutely, scientifically, proven that that's the case. So get over that, I would say, start with. I think a couple of our panelists have referenced that, you don't have to, sorry, Greg, I apologize in advance for this comment. You don't have to buy a software system. You could have an analyst with a spreadsheet and at least get started. It's more important to have a revenue management thought process and philosophy. Now, if you brought in Price Wizard or one of the others, you'll probably lift even higher as a result, but you don't have to wait for some huge implementation if you start really focusing on pricing and seeing the benefits of it. And there's no reason to wait. And you don't have to wait till your portfolio is large or there's third-party data available.
Thanks, David. And do you want to just touch on what's been going on in the US and how that could potentially impact the market here in terms of,
Yeah, I think I don't know all the details, but I do have friends who are still in multifamily there. And what I understand is it's not the concept of revenue management that's in question here.
Yeah.
It's how some of the data was shared behind the scenes. So please separate those two things. So when people in the UK or Australia or wherever say, oh, revenue management, I'm going to get sued, that is absolutely not the case. It's the way some of the data was handled. That's my understanding.
Yeah. So as Greg said earlier, your data needs to be siloed, and it's different operators should not be comparing data to set prices in the market.
Correct.
I mean, I think that it's pretty clear the CMA has already got one eye on the market here, so I think it would be foolish to do that. We're going to wrap up in a minute, but gents, thanks for your input today. It's been a really interesting discussion. Is there anything else you want to add before we move on? And maybe, Greg, just kind of give us a glimpse into the future and talk us about how dynamic pricing and particularly the technology is evolving and what we can expect next.
Yeah, absolutely. So AI is all the rage, and everybody is talking about generative AI, which is used for writing, and ChatGPT is an example, as I mentioned earlier. But we've been using since day one another form of AI, which is called machine learning, and continue to do that. I'll give you an example: forecasting market rent movements, for example, and we might be able to look at movements in vacancy rates in the market, and from there say, based on that and what's happened in the past, what does that mean for the future of market rent growth? And AI will be really, really helpful in doing that. So I think there'll be lots of changes, but whether we have those changes going fast or slower, I'm going to reiterate David's last point, and he probably didn't expect me to agree with him, but I will anyway. And I'll say, just get started, just do something. If you don't feel that you're ready to engage with an external software provider, just start getting better data, get all your data in one place and bring an analyst in. You can do a little bit with Excel. I think you can do a lot more with other tools, but it's better to do a little bit than to do nothing at all.
Yeah. Thanks, Greg. Richard, I forgot to ask you this question earlier, but taking into account your hospitality background, do you think dynamic pricing could extend to other aspects of the build-to-rent resident experience, such as amenities, utilities, room hire, this sort of thing?
Absolutely. And we've actually always started to do that. When we first commenced with Moda, we had this big plan, we're going to charge for all the amenities on top of the rent. And the market said, no, we're not going to do that. So we had to change. And that was dynamically decided that, we tried something. And I think that going back to what Greg was just saying, do something, try it. It may not work. And I think that's what we've learned constantly within Moda is let's try and do what we think is right. Let's listen to what people say and let's push the envelope if we can, but then change tact if you need to. So I think, yeah, the amenities within BTR, we've learned a lesson there. Now we diminish the amenities. The amenity war is over. So some of our newer developments have less amenity, great quality, great service, So yeah, I think that is a form of dynamically moving your business to be what's fit and right for your demographic.
Thanks, Richard. And you heard it first here, folks. The immunity war is officially over. It's been stated on a public forum.
Armistice.
Armistice, yeah.
Great stuff. Thanks, Richard. Thanks, Greg and David. Great session. We're going to show a few slides to wrap up, and we'll leave the session open for a couple of minutes at the end so you can take some notes from the chat. Our next webinar is all about the living sector investment landscape, and it's on the 31st of October, in case you were wondering why those rather spooky looking pumpkins are in the bottom of the slide. The link to register for that session will be posted in the chat, and it would be great to see plenty of you there. It's a really interesting topic at the moment, actually, and we're starting to see some distinct patterns and variations between the various asset classes in the living sector and their attractiveness to investors. So that's going to be a good session. So please register for that. Coming up very soon, we have our flagship live event for the Urban Living brand, and that's the Urban Living Festival, which is taking place in London on the 22nd and the 23rd. So not long to go. There's a link to book your tickets also in the chat. It'd be great to see you there. If you'd like to work with us at Urban Living News, either in our digital offers or face-to-face, do get in touch with my colleague Sam, whose details you can see on the screen and also in the chat. And finally, just want to say thank you very much to everyone. Thanks to David, to Greg and to Richard for their great insights today. Thank you all for watching. I hope you learned a lot. I certainly did. It's a really interesting topic. As I mentioned earlier, we are going to leave the session open for a couple of minutes so you can take some notes from the stuff in the chat. Other than that, enjoy the rest of the day. Have a great weekend, everybody, and I hope to see you on another webinar soon. Thanks very much. See you soon. Bye-bye.
At IHM, we believe in the power of connection. We exist to inspire, to inform, and to unite decision makers who are shaping the future of hospitality and real estate. Our why is simple. We believe this industry thrives when people and ideas come together. And we're here to make that happen. So how do we do it? We challenge the status quo by creating platforms that go beyond the expected. We blend intelligent content, curated events, and a strong community into everything we do. Making it easy, accessible, and genuinely useful. From online engagement to face-to-face connection, we're known for being insightful, collaborative, and refreshingly human. We publish 4 leading multimedia brands, each a trusted voice in its sector, delivering breaking news, bold opinions, and fresh trends. We host world-class events, panel discussions, podcasts, award ceremonies, and webinars designed to spark ideas, drive conversation, and create impact. With over 62,000 monthly web visitors, 55,000 email subscribers, and 69,000 social media connections. Our reach is deep, and our community is active. We're partnered with the biggest names in hospitality, and we'd love to connect with you. So whether you're looking to grow your visibility, meet the right people, or understand where the market's heading, read, watch, listen, and meet. Do it all with IHM.